Let's take a look now at a couple of charts on the inflation story. So we'll start with the inflation for the month. So we saw, the number came in at 3.4% for the 12 months to January. So that's the latest data we've got. Now that's following a 3.4% rise in December. Now, when you look at the chart, it looks like inflation is falling. But no, that just means that inflation is still growing, but just not at the higher rate that it was. So we're not in disinflationary territory. Prices are still going up. And so that obviously is a problem. Now, the most significant price rises were in housing. Remember, that's construction costs and also rents. So that was 4.6%. Food and non-alcohol beverages plus 4.4%. Alcohol and tobacco 6.7%. Again, off the back of the tobacco excise, I suspect, in there. Insurances and financial services plus 8.2%. So those insurance costs are really ballooning. Now, let's have a look at the second chart, which is the measure of underlying inflation. We've got a fair bit to talk about here because there's a lot to unpack in this particular story. So looking at the year-on-year story, the inflation rate is now at 4.1 to the December quarter. Now, that's down from 5.4 in the September quarter. So it was below market expectations of 4.3. So it surprised in good news on the upside. Now, this was the lowest figure since December quarter of 2021 as goods inflation eased for the fifth consecutive quarter and services inflation finally started to slow. And it's the second straight quarter in a row we saw some goods inflation coming down. Notably, let's go through unpack some of those numbers. Inflation moderated in food, 4.5 versus 4.8. Housing, 6.1 versus 7. Health, 5.1 versus 5.4. Transport, 3.7 versus 5.6. Recreation and culture, 0.5 versus 5.6. Education, 4.7 versus 4.8. And insurance and financial services, 8.1 versus 8.6. So they're all coming down. They're moderating, but still increasing. Costs fell in clothing. So this is disinflationary, negative 1.1 versus 0.9. Furnishing and household services, negative 0.2 versus 2.5. Now, bucking the trend, where price increases were quicker, included alcohol and tobacco, 6.6 versus 4.9, furniture 6.9 versus 4.9, and communications 2.2 versus 1.3%. So in terms of the RBA's preferred measure of reporting trim mean, and so Evan's going to unpack this in more detail, we saw that increase by 4.2% coming off 5.2 again in the September quarter, but remained outside the central bank's target of that 2 to 3%. That's our RBA target here in Australia. So, okay, Evan, plenty of data to digest here. The big question is, are we still walking a narrow path? Is the RBA going to be able to do that? Or are they going to also face the challenges of sticky inflation, which is what we're seeing starting to show up in the US?
So they are still walking the narrow path with the data that we have. I think that needs to be put out there first and foremost, is that, yes, they're still on track. When you look at, you talked to us before about something like tobacco, for instance. Don't forget that there was an increase in taxation on tobacco that can explain most of the price increase there. You highlighted also what we've been discussing through this entire talk, which is imported goods, things like apparel, things like overseas travel, all these kinds of things, they're contracting. And that's consumer behavior also that we've discussed. So there are all of those sort of signals that we need to see are working in the right direction. However, there are outside of the control that is a concern. You've highlighted very particularly what's going on in housing. And don't forget, housing makes up around about 11 to 12% of the entire inflationary story. Yeah. So it's a big one. And that's the one, the moment it started moderating, but it's ticked back up again. Services also, and again, they are and will be the headache. But overall, it's still, at the moment, walking the fine line. The question is, do we start following the US and we get to about 3% and we start to moderate and plateau rather than dropping into the 2 to 3% handle? And you can see from the chart on screen, we're still a full 1.1% away from where we need to be at the top of that band, not even in it, just to touch it. Yep. So there is growing things in there. That's why there is a little bit of nervousness, why some people are still quite hawkish. As I've said, I'm still going to put my hand up and say, I know I'm going to get this wrong, but that's all right. I still think interest rate cuts are coming this year. Yep. I still think it's in the second, probably actually the final quarter of this year, because the RBA is all of a sudden is going to start cutting when the tightness gets to a level that GDP starts to really fall and unemployment really ticks up. But it won't be at the same speed probably that I was hoping. And as I said, the unknown quantity is fiscal spending and what the government does to try and counteract it as well.
Well, I think you've nailed it there for me. I would move my forecast if I see a stimulus budget come out from
May's going to be incredible.
So it's definitely going to be a bit more challenging. So most of us would like that cost of living support, but we then realise, wait a minute, it's then going to add to higher inflation. And so for those of us who are
what is it, hand in glove problem? So I mean, again, so all of what we're discussing here is that you give with one and take from the other.
Yeah,
and again, the discussion that we'll have in a minute is also around, are interest rates actually impacting evenly with regards to what it's doing on the economy? Because there is certainly growing data that it's not, but we'll come to that in a minute.